The US has been running massive trade deficits for decades. It buys far more from the world than it sells. But why does the world's largest economy operate like this? The answer lies in the way the US economy is structured. It's driven by consumption. Americans spend a lot, often more than they save, and that high demand fuels both the domestic economy and international trade. However, this constant spending comes at a cost. Over time, it has pushed the US national debt beyond $35 trillion. Now, global credit rating agencies are sounding alarms and have even downgraded the US credit rating in recent times. But what if I told you? This whole setup isn't just a policy flaw or an economic blunder. It's actually built into the system itself. And the reason behind it is something called Triffin's dilemma. So, what is Triffin's dilemma? It's a paradox that any country faces when its currency becomes the global reserve currency. Right now, it's US dollar. The dollar isn't just America's currency. It's the backbone of global trade and finance. Countries around the world rely on it, whether it's to buy oil, pay off international debt, or build up their foreign exchange reserves. Simply put, the global economy needs a steady flow of dollars to keep running smoothly. So how does the world get all these dollars? Well, the US has to make sure there's a constant supply, and the most reliable way to do that is by running a trade deficit, meaning the US buys more from other countries than it sells to them. As American dollars are spent on imports, they flow out into the world, eventually landing in foreign central banks, global corporations, and international markets. Now, this steady outflow of dollars is great for global liquidity. It keeps international trade and finance moving, but it comes at a cost. To keep supplying the world with dollars, the US has to keep running trade deficits, and over time that means piling on more debt. As these deficits grow larger and more frequent, investor confidence begins to erode. People start to worry about inflation, about the value of the dollar, and about the overall stability of the US economy. And here's why things get risky. Since the US borrows in its own currency, the Federal Reserve can technically print more dollars to meet debt obligations. But printing more money fuels inflation, and because the dollar is used globally, that inflation doesn't stay within US borders. It spreads across countries, affecting prices, trade balances, and financial markets worldwide. In short, the dollar's global role creates global consequences. As global inflation rises and US debt keeps climbing, more and more countries start to question the dollar's value and stability. And when confidence in the dollar wavers, everything that depends on it, global trade, finance, and reserves, becomes vulnerable. Here's the paradox at the heart of it all. If the US tries to cut its deficit to protect its own economy, the rest of the world faces a shortage of dollars, which can slow down global growth. But if the US keeps running big deficits to keep the global system fed, it risks piling up too much debt and triggering inflation. There's no simple solution, and that's exactly what we call Triffin's dilemma. But trade deficits aren't the only way the US sends dollars into the global economy. Capital flows like loans, foreign investments, and foreign aid also move dollars around the world. Here's the catch. These capital flows are usually temporary. Eventually, the money comes back when loans are repaid or when investors sell their assets. And this returning capital plays a crucial role. It helps the US fund its own deficit. Countries that earn dollars by trading with the US often take those dollars and invest them back into US Treasury bonds or American companies. So, the dollar leaves the US, circulates globally, and then comes back home, creating a continuous cycle. This is the heart of Triffin's dilemma. To keep the global economy moving, the US has to keep spending and sending dollars out into the world. But at the same time, this spending puts its own economic health at risk. It's a built-in contradiction with no simple solution. So next time you hear about US debt, inflation, or the dollar's role in the world, remember, it's not just about domestic decisions. It's a deep structural paradox that influences how the entire global economy works. Now here's where it gets even more interesting. In 2024-25, the US, during the Trump administration, made serious efforts to fix its trade imbalance. One of the main steps taken was to impose heavy tariffs on goods coming from trade partners. At the same time, policies encouraged both American and foreign companies to shift their manufacturing plants back to the US. The goal was to cut down imports, boost local production, and increase exports. But these efforts came with consequences. Trade restrictions and rising costs didn't just affect the US, they sent ripples across the global economy. The world, which grew by 3.3% last year, is now expected to slow down to just 2.9% growth in both 2025 and 2026, according to the OECD, Paris. And this brings us right back to the heart of Triffin's dilemma. When the US tries to fix its own economic issues by reducing its trade deficit, it also reduces the flow of dollars to the rest of the world. And since the global system depends on a steady supply of dollars, this creates shortages, slows down growth, and causes strain far beyond US borders. So in trying to solve one part of the problem, it ends up making the other part worse. That's exactly what Triffin pointed out. The US has to choose between global responsibility and national stability. But either way, someone pays the price.